Welcome to the Cover Your Assets podcast, a show for the physician who understands the importance of protecting everything you've worked so hard to achieve. If you're ready to find the peace of mind that only financial security can bring, let's get started. Here's your host, Billy Gwaltney.
Welcome to today's episode of the Cover Your Assets podcast. I'm your host, Billy Gwaltney. Excited to be with you to cover our topic today, which is the quote spreadsheet overview that includes the benefit increase rider. If you're listening to this or watching this, you're probably a resident or fellow in training looking to purchase true specialty on occupation disability coverage. I'm an independent broker, work with 3,000 or more physicians across the country, helping them secure coverage. And I want to give a quick summary of the PDF that you've received from me that goes over the quotes, kind of where the rubber meets the road. What makes this coverage so important is that it's private, it's portable, it's also non-cancelable and guaranteed renewable, which means the insurance company can never cancel the policy, or now you can cancel at any time, but they cannot. They can never change the definitions, and they can never increase the rate. And so the spreadsheet shows discounted rates for $5,000 a month of coverage with the 4 top true specialty disability carriers. Now, I'm an independent broker. Most independent brokers have access to probably 75 or 80 insurance companies. The 4 on the spreadsheet are the only 4 that you would want to have throughout your career. It's kind of an odd landscape where these 4 are excellent. Probably, 90% or so of the contract language is the same with all 4. They're essentially interchangeable. The contracts are very solid. These companies have been around for 125 years, I think is the youngest one. They know what they're doing. They've been offering policies for longer than most of my clients have been alive, maybe longer than I've been alive too. So they go back quite a ways. We do have clients on claim, unfortunately. I wish we didn't, but we do. And they all get paid. That's the good news. It does exactly what it's supposed to do. But outside of these 4, it's important to understand that it's like falling off a cliff. So this is not, there just aren't many companies that do it well. This is not a list of the top 4 out of 20 or the top 4 out of 10 or even the top 4 out of 5. Okay. None of these companies pay my rent or overhead, so I don't answer to them in that regard. We have clients with all 4, and a lot of it just comes down to what fits your situation. As you look at the rates on the spreadsheet down at the bottom, it is totally okay to pick the cheapest one. Rates are driven primarily by 2 things. One of those is your specialty. And the other one is the discount. Okay. Now specialties are assigned an occupation classification by each insurance company based on how that company's actuaries assess the risk of a particular specialty. And so most specialties are in similar occupation classes from a risk standpoint, but sometimes there's a variation, which can cause one company's rates to look oddly different, either higher or lower than the others. And sometimes it's because of the specialty. The other variation or difference in the rate is the size of their trainee discount. And companies determine their discounts essentially based on their desire for growth. One company's discount is 10%, as low as 10%. Another company's discount is 31%. The difference there is just the one with 31% is more aggressively growth focused than the company with 10%. And so there's nothing wrong with you taking advantage of that. I tell clients, you can pay more if you want, but this idea that, hey, you get what you pay for, which is generally true. That's a good kind of rule of thumb to live by. There are exceptions where you can suspend that a little bit. And if it has these key definitions that we're going to go over on the spreadsheet, then it's totally okay to gravitate to the least expensive one. Okay. So that's kind of a quick overview. Each one of these 4 contracts, Mass Mutual, Guardian, Principal, and Emeritus, they're excellent. Okay. They are independent of each other, but you're going to discover as we go through this that the vast majority of their contract terms are the same. Okay. So there's a lot of similarities. We'll discuss the differences, which are more secondary. So starting at the top, if you are, we list your specialty, what state you're in, that has some bearing on the rate. Your age obviously affects the rate. What these companies do is they allow trainees to purchase up to $5,000 a month while they're in training, fellowship, or residency. There's no law that says you have to start at 5,000. So with Emeritus, the company to the far right, we put 2,500 just so you can see it. You'll see a linear relationship between the benefit and the cost. Emeritus recently increased their maximum to 6,000. One of the other companies, I believe Mass Mutual, is at 5,500. They occasionally will bump that up, but the rule of thumb where most people tend to default is 5,000 a month. So that's why we put these examples here. This is a non-taxed benefit, which means if you receive it, you don't pay any income tax, state or federal, on the benefit. The reason is because the premium that you pay down at the bottom for the option you choose is paid with after-tax funds. So they usually draft it from a checking account, or you send in an annual premium check, but it's paid from your personal checking account, which is post-tax dollars. Therefore, the benefit is non-taxable. Okay. The elimination period of 90 or 180 days is how long you self-insure from the date of a disability until the first check shows up. So it's how long you wait. If a disability occurs in January and you have a 90-day elimination, you get your check in April. If you have a 180-day elimination, you get your check in July. Okay. And you decide that. So you're not guessing, you're not wondering when you're going to get it. You're going to know that up front. There's a little bit of a cost savings if you pick the 180 over the 90. The benefit period is to age 65, which is pretty customary. You could get a benefit period to age 67, and in some cases to age 70. The cost is higher for that. Most people still tend to default to 65. So that's why we put this on the spreadsheet. Now we get to the meat of the coverage. The definition of disability is called true specialty on occupation. And that definition means two things. One, it means that if an illness or injury prevents you from performing the material duties of your specialty or subspecialty, then you are totally disabled for policy benefit purposes. The second thing it means is that there's then no penalty for income you later earn doing something different. So if you can't practice your specialty, those important duties, then you're disabled. You can then go consult, teach, write a book, do whatever you want to do, make an unlimited income doing that, and there's no penalty to your benefit. So it's the best definition you can get. All four contracts include this. The next line is the benefit increase rider. This is what allows you to expand or increase your coverage once you become an attending. Now, as I said, for trainees, residents, and fellows, these companies allow you to purchase $5,000 a month, regardless of your trainee salary. So they're technically not financially underwriting you. But when you become an attending, there's a formula that companies use to calculate how much coverage you can buy, because they really don't want people overinsured if they can help it. Now, the $20,000 or $30,000 maximum amount you see for each company is the maximum amount of insurance they will let any one physician have with them, regardless of their income. So that's the maximum cap. Now, that doesn't mean that everyone can buy that much just because they're willing to pay for that much. As I said, they really don't want people overinsured. And so when you become an attending, we put the numbers in the formula. It includes your annual salary pre-tax, as well as a portion of any group long-term disability that you are provided through your employer. And there's usually a gap, and whatever that gap is what you can increase to as an attending. The maximum amount, as I said, is $20,000. To get to $20,000 a month, you'll see that with Mass Mutual, and in some, depending on the specialty you're seeing, it could be $20,000 with principal. The maximum amount of $20,000, it takes a pre-tax income of about $600,000 to get to $20,000 non-taxed private benefit. With Guardian and Emeritus, you'll generally see $30,000 per month, and that would fully insure. It takes about $1.2 million to get to that level. Okay, so the maximum amount of insurance, generally speaking, kind of a rule of thumb, is that we can get clients that want to maximize their coverage to about 75% of their net pay, okay, of their post-tax pay. That's about as close as an insurance company wants someone to get before they get nervous about them being overinsured, which means they're concerned about people actually becoming too creative about how to become disabled. Um, kind of weird to think, but that's human nature, I guess. So insurance companies are pretty concerned about that. And so that's the formula they use to calculate how much you can buy. Once you increase to that amount, it's yours forever, regardless of whether or not your income dips later. As long as you pay the premium for the amount of coverage you have, that's your coverage forever. They can never take it away from you, okay, until age 65. And then the policy can continue with a 2-year benefit period if you're working beyond age 65. There's another podcast that covers that in more detail. Every 3 years you see in parentheses means that you're eligible to increase your coverage in 3-year increments. Okay. There's a schedule that these insurance companies want you to kind of follow where every 3 years we need to update your income with the insurance company in order to determine if you're eligible for more coverage. If we don't update your income with the insurance company, they'll remove the rider. So if you ghost them, they're going to take the rider off the policy. Okay. There are exceptions to the 3-year rule. One of those is graduation. Usually certain triggering events, life events where you have a significant income increase or you change employers and lose benefits. They'll allow you to increase outside the 3-year schedule. Okay. So if you buy this as a trainee, you don't have to wait 3 years into your attending salary before or career before you can increase. You'll be eligible to increase as soon as you become an attending. Linear cost means that there's a proportional relationship between the benefit and the cost. The rate's down at the bottom for $5,000. If you 3x that amount, you'll 3x the cost. That's what that means. Whatever you buy at your current age will stay fixed forever. Okay. If you're 30, whatever you pay for the age 30 rate that you buy, that amount of coverage will stay at that rate fixed forever. It never increases. Contractually can never go up. When you go to increase coverage, $10,000 a month would cost twice the amount for $5,000 a month, with an adjustment for your age at the time you do the increase. So if you're 32 or 33 when you do the extra $5,000, there's going to be 5 or 6%, maybe a little bit more, just depending on the company. Maybe say 5 to 10% difference in the cost for that extra 5,000. Okay. But that rate from that point forward would then stay fixed. Okay. So the benefit to the benefit increase rider is that when you go to increase coverage, you're contractually guaranteed to get the trainee discount. You're contractually guaranteed to get the same exact definitions, and you're contractually guaranteed to not have to redo any medical screening. If you have coverage and you have the benefit increase rider on the policy, then you never have to be reevaluated or answer medical questions when you go to increase coverage. Okay. So that's the incentive for making sure that you don't have the rider removed from the policy because you don't update your income. Now, as a broker, I'm a specialist. This is what I do morning, noon, and night. I love it for some reason. We serve our clients wherever they live across the country or across the world for that matter. We have clients everywhere, which I love. We're in touch. We're reminding our clients to, hey, make sure we get your income, to make sure that your 3-year anniversary is coming up. Let's make sure that we take the 3 to 5 minutes it takes to update that online. We provide the link to do that. And so there are plenty of reminders to make sure that you do it, but we do need to do it. The other thing with the benefit increase rider before we go on is that when you go to increase coverage in the future, you're required to increase by at least 50% of the additional amount of coverage you qualify for. Okay. And what that means is that let's say you had $5,000 a month, and then as an attending, when you go to increase coverage, the formula based on your salary and group long-term disability confirms that you're eligible for $10,000 a month. Then you need to increase up to at least $7,500 a month. Okay. If you don't increase by at least half, then they would take the rider off the policy. So at that 3-year anniversary, let's say that you buy $5,000 a month and you don't increase right away. 3 years from now, you're eligible for $15,000 per month because your income has continued to go up. They're going to say, okay, you need to at least bump up to $10,000 a month, or we're going to require you to stay at $5,000 a month forever. Okay. And then if they take the rider off the policy, then in the future, if you wanted to increase, you would have to start from scratch. You wouldn't get the discounts. You'd have to redo the medical screening. All bets are off. Okay. So there's a significant incentive to make sure the benefit increase rider stays on your policy. The vast majority of our clients want their coverage to scale with their income. It's wise to do that because, again, insurance companies don't want people overinsured. And so if they're telling you qualify for $15,000 a month, that means that based on their detailed analysis, financially, you're going to need it if you became disabled. Expenses go up, mortgages need to be paid, schools need to be paid for, and so for children. And so most of our clients tend to gravitate really close to the maximum, if not at the maximum. Okay. But just happy to discuss this with you in more detail. Just want to give you this as much detail as I can in this overview. The next on the spreadsheet is the enhanced residual benefit. This is partial disability. So the enhanced residual benefit pays for partial disabilities if you can do your specialty or subspecialty part-time, but not full-time. Okay. Then you can do your specialty duties 4 hours a day, but not 8 if you work an 8-hour shift, or part-time. You just can't do it as full bore as you were, and your income suffers. Then whatever the percentage loss of income you suffer, they would pay that percentage of your policy benefit. The 15% you see in parentheses is the minimum income loss required to activate that benefit. So once your income loss is 15% or greater, this benefit is activated, and they'll pay that corresponding percentage income tax free. So it's not all or nothing. Really important. The next right below it is equally vital, the recovery benefit. This is usually explained in the same part of the contract as the enhanced residual benefit, but it is separate. The recovery benefit pays if you medically recover from a disability, return to work, but when you return to work, your income does not recover to what it used to be. And that happens a lot. We have clients that have collected for over a decade from a recovery benefit because they're medically cleared to go back, but they've been out for 2 years or 5 years. And when they come back, they just never reach the same level of productivity. They're starting from scratch. Their income just doesn't bounce back. And so the recovery benefit would continue to pay you if that happened. That's vital. Again, 15% is the minimum income loss required to activate that. So the things we just went over, the definition of disability, the true specialty own occupation definition, the enhanced residual benefit, and the recovery benefit. This is like a three-legged stool. These are the three non-negotiables to this coverage. If you move one of the legs from the stool, it becomes unstable really quick. It's vital to make sure that you have all three, and these 4 contracts have that. Then you add on to it the benefit increase rider that allows you to increase coverage as an attending with contractually guaranteeing those definitions included. Okay. If you get outside of these 4, one or more of those gets removed. Okay. So it's vital to make sure that you stick to these 4. I would love to work with you, but make sure, if it's me or somebody else, make sure you have one of these 4. And it's possible to have these 4 companies and not have these key elements. Okay. So the first thing is to make sure you have the right company. The second thing is to make sure it has all of these definitions attached to it. Okay. The details matter. The next on the spreadsheet is the psychiatric benefit. This pays for disabilities related to addiction, depression, and anxiety. You'll see that most companies would pay this for 2 years. Mass Mutuals is 2 years per occurrence. Guardians is to age 65 generally. That's what they're kind of known for. That's why someone would pick Guardian. Principal and Emeritus offer 2 years per occurrence. You'll see with Emeritus, you can increase that up to age 65 if you pay 10% more. That's technically true with all 4 of these for most specialties. You could increase the psychiatric benefit to age 65 with Mass Mutual, with Guardian, with Principal, and Emeritus. But the cost would be higher than what you see on the spreadsheet if it's a 2-year psychiatric benefit. What we typically discuss, kind of some thoughts on that. We've not seen a claim go beyond 2 years for a psychiatric benefit. Obviously, that's anecdotal. It doesn't mean it can't happen. Okay. If streamlined medical screening is usually required for this coverage, if it is required, then which it almost certainly is, there could be exceptions. That's why I just say Maybe there's an exception. I don't know. But if you're looking at this spreadsheet, it's safe to assume that you're going to need to answer medical questions. And if you do, they're going to ask about previous treatment for anxiety or depression. And even if there's been treatment for mild anxiety within the last handful of years, typically they're going to exclude the psychiatric benefit. So people that a lot of times will gravitate to that and want the age 65 maybe are inclined to think that way because they've already been treated, and they oftentimes can't get it. Okay. So it's kind of like the bank. If you go for a loan to the bank, they'll give you the money if you don't need the money, but if you need the money, they're not going to give you the money. I wish it wasn't that way, but that's kind of how the psychiatric benefit works. But it is possible to get it to age 65 if you want it. Most of our clients don't tend to want that. If it is important, that's what Guardian is known for. They're excellent at that. They're proud of that. That would be the reason to gravitate to Guardian. Okay. Emeritus is good at it, but Principal and a Mass Mutual can add it as well for a cost increase. One last note, if your specialty is emergency medicine, anesthesiology, or pain medicine, the psychiatric benefit is typically limited to 2 years. There isn't a to age 65 option. Next on the spreadsheet are 2 perks related to Emeritus. We put these in there because they're popular and you're not paying an extra fee for them. Benefit advancement, Emeritus will pay up to $500 towards any medical treatment for minor injuries. So if you ever go to urgent care or get stitches or x-rays or get treatment, an MRI, an injury, not an illness, it's not treatment for COVID or the flu or any of that, but for an injury, working out, hiking, it could be work related, it could be non-work related. If you get that medically treated, they will pay you up to $500 towards that treatment, even if you don't pay anything out of pocket. Okay. There's no limit to the number of occurrences you can use it. They can't raise your rate. They cannot exclude the injured area. There's really no downside to it other than taking the time to fill out the quick claim form and submit a copy of the billing that the provider submitted to your insurance. And they'll deposit a check for $500 or whatever it is, up to $500. A lot of clients like that. No extra fee for that. The good health benefit is another perk where every year someone has a policy with Emeritus and is not disabled, which means they're not on claim, which is how they define good health, is simply not being on claim. They're going to drop the 90 or 180 day elimination period by 2 days. So that's going down 2 days per year over the life of the policy. If you're in your early 30s, 15 years from now, you're in your late 40s, you would have a 60-day elimination instead of a 90, or a 150 instead of a 180, which means you get an extra check. You not only get paid sooner, you get paid extra money for those extra days. Okay. And it's just a perk that they add. Both of the benefit advancement and good health benefit are just incentives that Emeritus adds, and they're attractive to people. So we put those there just so you can see it as food for thought. The cost of living adjustment, the last item here before the premium section, or COLA. This is an inflation factor that increases your benefit once you're on claim to offset inflation. Okay. It's not required to have it. It's not an increase while you're working. It's an increase once a claim is filed. So if someone is disabled in their early 30s or mid 30s or early 40s, and they're going to collect to age 65, inflation is going to be felt probably by them over the course of that claim. It would probably be nice to have an inflation adjustment on there, but it's not required. And so we include the rates with it and without it. Each company calculates it a little bit different. Mass Mutual and Guardian just do a fixed 3% compounded. Principal and Emeritus go 0 to 3% based on the Consumer Price Index, which is the U.S. economy's gauge for inflation, the national gauge of inflation. So it's going to hover around 3% typically, historically, and they're going to compound that as well. So the rates, the monthly premiums down at the bottom are the discounted rates based on the elimination period you choose and whether or not you opt for the COLA rider, cost of living adjustment rider. Again, the cost of living adjustment is not required, so we show rates with it and without it, and you can pick the elimination period. A lot of clients ask me, which one should I do? Well, I can't go on record recommending less coverage or no COLA or waiting longer, because if you complain about that and you said, I told you to do that, I would have some explaining to do. So I can't officially recommend the 180 without, but I can say that I understand it's a personal choice. I don't debate people on which one they should choose. I do say the COLA is, I would say the vast majority of our clients get that because it is something that over time, if a claim lasted a long time, it would be nice to have that. Typically when the claim happens, expenses go up pretty quick. So people want to check right away or as soon as they can get their hands on it. So that's where, if you're disabled, you're going to want the 90-day with COLA. If you're not disabled, then that's where the 180 without COLA is more beneficial, right? Because you save money. But it is a personal call. I would say the majority tend to gravitate to the 90 with COLA, but we certainly have exceptions, and I wouldn't tell somebody the sky is falling if they picked one of those other options. One last note to wrap up. Your broker really matters. These details are important to make sure that you get exactly right. The time to find out they're right is not at the time of claim. The time to do that is up front. Please work with a specialist. I'm a specialist. This is what I do, as I said, all day, every day. Would be happy to help you. But whether it's me or someone else, just make sure it's someone that knows that these key elements are required, and they can also get you the maximum trainee discounts and will help navigate the medical screening for you as well. I hope you found this helpful. I'm sure there's more to it. The medical screening is a separate conversation. I'm going to do an updated podcast on that will follow that just explains the quick process for that. It is very short, shortest than it's ever been for you. And if you have questions, want to go over situations related to your specialty or your where you are, what you're planning to do with your career, would be happy to discuss those with you. One thing to circle back on the psychiatric benefit, anesthesiologist and emergency medicine, and in some cases pain medicine, there are certain exceptions where the specialty cannot get a psychiatric benefit to age 65. I did not mention that in the psychiatric section. Just remembered that. Wanted to circle back to that. Hopefully you've listened to this all the way through. Please feel free to reach out to me. Text me if you'd like to discuss further. 704-270-2376. Again, 704-270-2376. I enjoy our time. Thank you for taking the time. This is Billy Gwaltney. See you next time.
Thanks for listening to the Cover Your Assets podcast, a Work P2P production. New episodes drop every 2 weeks. If you've enjoyed the conversation, subscribe, rate, and review this podcast. For more tips and advice, visit the website and YouTube channel. Check the show notes for links. Join us next time for another episode dedicated to helping physicians like you get your disability insurance right and protect your way of life.